From a US perspective, Pakistan's interest in joining BRICS reflects a familiar calculation by many emerging economies: diversify trade, reduce exposure to dollar volatility, and seek alternative sources of investment at a time of persistent balance of payments stress. For Washington, the move is not automatically adversarial, but it is consequential. Pakistan's trade profile has long been constrained by energy imports, a narrow export base, and periodic external financing gaps. BRICS membership could, in theory, widen market access, encourage local currency trade arrangements, and open doors to development financing outside traditional Western-led institutions. Countries within BRICS emphasize infrastructure, manufacturing capacity, and South-South trade, areas Pakistan hopes will lift exports and stabilize growth. From a US lens, this is a pragmatic hedge rather than a wholesale pivot away from the West. Still, BRICS today is not just an economic club. It is increasingly a platform where members experiment with reduced reliance on the dollar and coordinated positions in global forums. That matters to the United States, which remains Pakistan's largest export destination and a key source of market access through textiles and services. Any attempt by Islamabad to rebalance trade flows must contend with the reality that US demand, compliance standards, and supply chain integration are difficult to replace quickly. Washington will also read Pakistan's BRICS bid through the prism of regional geopolitics. Deeper economic engagement with China, already Pakistan's largest infrastructure partner, could expand under a BRICS umbrella, potentially reinforcing Chinese influence in financing, technology standards, and strategic assets. From the US standpoint, this raises questions about transparency, debt sustainability, and governance, issues American policymakers consistently flag when alternatives to Bretton Woods institutions gain traction. That said, a Pakistan with broader trade options and steadier growth is not inherently against US interests. Economic stability can reduce crisis diplomacy and repeated bailouts, including reliance on the International Monetary Fund. If BRICS-linked investment complements, not substitutes, market reforms, export competitiveness, and regulatory improvements, Washington could quietly welcome the burden sharing. The concern arises if BRICS alignment translates into closed standards, opaque financing, or political signaling that sidelines cooperation with the West. In practical terms, the US-Pakistan relationship is likely to become more transactional and selective. Trade, climate resilience, health security, and regional stability can continue even as Pakistan explores BRICS. The signal Washington will watch most closely is not the application itself, but the follow-through, currency practices, procurement transparency, debt disclosure, and openness to US firms. If Islamabad keeps those doors open, BRICS membership may be seen in Washington less as a rupture and more as Pakistan's attempt to broaden its economic toolkit in a multipolar world.